Major funding for these programs is provided by HSH Nordbank and First American Title Insurance Company of New York, Perfect Building Maintenance, Allied Partners, Greenberg Traurig LP, the Moynihan Group. Additional funding is provided by Antares Real Estate, Arbor Realty Trust, C.B. Richard Ellis, City Habitats, City Investment Fund, Cushman & Wakefield, Eastern Consolidated, Essex Capital Partners, Fremont Investment and Loan, James D. Kuhn Real Estate Institute at Syracuse University, Massey Knackle Realty Services, Meridian Capital Group, McSam Hotel Group, MUSS Development, LLC, Newmark Knight Frank, Palin Enterprises, Rosenthal & Rosenthal, Inc., Swig Equities, the Engel Berman Group, Titan Capital, the WITKOFF Group, YL Real Estate Developers, Extreme Contracting and Deconstruction.
Hello, my name is Michael Stoller of the Stoller Report. Who is building, who owns all this property in New York? Who are the 850-pound gorillas? Today I have the gentlemen who really control these real estate investment funds, the guys who invest in all different types of properties in New York. And they're going to provide to my audience information on what they like, what they don't like in the boroughs and so on. My guests today include Jeffrey Kaplan, Managing Principal, Westbrook Partners, Tom Lydon, President of the City Investment Fund, and last but not least, John, a.k.a. Jake Jacobson, Managing Partner, Apollo Real Estate Advisors. Thank you for all being here today. So, you've invested $6 billion around the country, a good portion in New York. You've invested $770 million, and now you're raising another fund. You've invested $9 billion. Look at all this money. Look at all you're doing. So, what do you like? What do you like about New York City, Mr. Kaplan?
Not much these days. Prices are pretty high. No, the attraction to New York City for us is job growth and liquidity. And I think what we've found as we look back at the $6 billion, closer to, it's probably $6 billion worldwide, not just U.S., is when times get tough, the big liquid markets are the ones that hold up. So we see a lot of downside protection despite extremely high prices, record-setting high prices in New York.
But you know, prior to the show, you just said you're in contract for an office building. I won't announce it because it's on Madison Avenue. You bought a building on Fifth Avenue. I mean, these prices, you're still buying. Lydon over there, he can't go out. The City Investment Fund, he's only allowed to invest in the 5 boroughs. It's even hard for him to go out to Staten Island. Okay, now he's raising in the little fund so he can go 50 miles. Jake, he can go wherever he wants. I mean, you guys are telling me you can't find anything here? Jake?
We're finding new stuff to do all the time, but we have to be very, very selective. I mean, prices are at record levels, but a lot of the reason that prices are at record levels is because the fundamentals have been very, very good. I mean, we've spent a lot of time in the residential market in particular. We think there's still an undersupply of rental residential in Manhattan, and frankly, of quality in the boroughs as well. So we've been buying a lot of stuff to fix it up, and we would love to be able to figure out a way to develop new rental.
I mean, Tommy, you know, you've done a lot of residential, just like Jake, and you're even thinking of developing some residential rental.
Yeah, well, we went early on when the fund closed in early 04, we purchased about 4,000 units of mostly rent-stabilized apartments in Bronx, Queens, and Brooklyn. And we've actually already started to sell off those because new investors have come in, and we found we could exit those at higher prices.
You mean like this guy who just recently bought some?
I'm not sure who they were, but a lot of investors have come in. But then we recommitted and just closed on buying 4,000 units in Manhattan of properties that were formerly in the Mitchell-Alma program, mostly in Harlem, one on the Upper West Side, one in Roosevelt Island. And again, going to Jake's comment, the answer is there's still a lot of value. There's a lot of rental growth. You can improve the apartments and still provide very affordable housing to the people living in those facilities. Very little risk of vacancy, and you really just have to control your costs, and if you believe the market's going to move up, the value there is perhaps $30 a foot in rents, new construction, not even I'd call luxury locations are getting $70, $75 a foot. So still you're providing good affordable housing and you'll keep it full. So
is that the reason why you guys went in recently?
You know, one of the big, yes, one of the big things that we're attracted to still, whether it's residential rental typically for us or office, is still a discount to replacement cost. You know, we were talking about this again before the show, prices to build new, you know, we're still buying at a significant discount of existing, fine, maybe it's B quality product that we'll put a little bit of money in and hopefully, you know, raise rents, but still a tremendous discount to replacement cost. And find that attractive too on the residential side.
I think it depends on where you are as well. For a prime location and at those rents that you were talking about, Tom, I think there is an ability to build new if you can get a site for the right price and if you can get your construction costs, you know, really nailed down. But predominantly what we've been doing in the boroughs, for example, we'd rather buy it today, even as prices have gone up. And we've seen the exact same thing over the last 2 years. We've bought close to 11,000 units in one way, shape, or form in the last 2 years. And we've seen prices run up all the way through because there is a lot of investor interest in that type of product.
You know, that's the residential. What about, you know, condomania? I mean, I think we were talking prior to the show that, you know, maybe 2 years ago when you opened up 505 Greenwich, they were sold like that. When you, even some of the buildings that you've done, and do we have condomania in New York City today?
The residential end you're talking about?
Yes.
Oh, certainly. We, you know, because our fund didn't start till 2004, we entered into about 6 or 7 development opportunities, primarily in Manhattan, but some in Brooklyn, one in Riverdale. And I was a little bit concerned with the market in the fall. We had cost increases a lot. Land prices were fairly high, so the margins were getting really narrowed. But in almost all cases, after the end of the year, first of the year, prices have just increased dramatically. You'd have to say 10, 20% based upon...
So you're saying to me that a condo that you've had, I mean, can you really make that generalization on all the condos, or is it because of the location?
I'd say Manhattan overall, unless you're in a very poor location or poorly designed product, has had a tremendous bounce back in the first quarter, I think across the board. I'd say other locations in the boroughs, maybe less so depending on location. I think, again, the waterfront in Brooklyn selling nicely, but I wouldn't call exceptionally. Long Island City selling nicely, but not the same market push that Manhattan has. We have a property in Riverdale which has sold fairly slowly, even though the prices are very attractive when you look at them on a nominal basis. Very big difference between Manhattan proper and other locations around the city.
We've had the same experience in Manhattan. We're in the midst of 2 projects on the Upper East Side right now, one of which is a ground up on 86 and Lex, and the other is the conversion of the old Stanhope Hotel on 5th Avenue. And there was definitely a lull about a year ago. Costs have gone through the roof, but prices have now more than made up for that.
Speaking of the Stanhope, you know, there's been mixed signals.
You like to speak about the Stanhope?
No, you brought it up. I didn't. I mean, it's a great location. It has 8-foot ceilings. It has some negatives about it. Are sales getting better, or are they having continuous broker parties?
No, we're over 50% sold. The problem with there are a number of problems with that deal. The main problem with that deal is that we made a decision early on not to build a sales center on site. And that was the right decision from a construction perspective, but it was obviously the wrong decision from a marketing perspective. And the project got this reputation for having low ceilings, which it does. It has relative to other pre-war buildings, but it doesn't have low ceilings. It has 8.5 to 9 foot finished ceilings. It doesn't have killer dramatic park views. It has views of the Metropolitan Museum of Art right across the street. It's great. It's not 15 Central Park West, but it's classic pre-war 5th Avenue. And until we could get people inside and in the form of a finished model apartment, we really couldn't sell anything. And we had literally a handful of sales until we opened the sales office in April. And since that time, we've sold just a little over now 50% of the project.
You know, we're talking about Manhattan and certain things. I know Tommy is involved with a project which I consider it Harlem, but people don't consider it Harlem. It's 111 Central Park North. I know Jake's been involved with a number of projects north of 96th Street. I don't know if you've done anything north of 96th Street in development.
Development, no.
Or even in ownership.
One small deal, but it's been largely Bronx.
But my question is, what's the feeling with regard to north of 96th Street in a variety of things? In the category of residential rentals, the category of condominiums, and retail. And I preface it, I was coming off the FDR drive yesterday, and I took 2nd Avenue, and I saw this condominium of someone who was on my show a couple weeks ago called the Ivy on 118th and 2nd Avenue, which is sold out, and I said, this sold for $750 a foot. I mean, it just didn't seem right.
But the same disparity exists in Harlem, in the condo market versus in the rental market. So we have people in the Savoy, our rental, in Harlem, who are very excited about the unit they're getting for $30 to $35 a foot, and the comparable stuff that they were looking at was, you know, $55, $60, $65 a square foot. So they're getting a lot more room for their dollar, and it's actually become a cool neighborhood. It's a hip place to go for a rental. So the same, I think, exists in the condo market, because you're talking about pricing that's half of a lot of locations of buildings being built in Midtown and other parts of Manhattan. So if you can get the same space or more space for half the price per square foot, eventually that's got to find a lot of buyers, I would think.
Or if you produce the unusual, 111 Central Park North is unusual that it's 48 2- and 3-bedroom units, all with park views, full park views, sitting right on top of an express station at Lenox Avenue. So again, we didn't appreciate it. I don't think we appreciated it when we went into it with our partner, the Athena Group, as to who would be that buyer. And the buyers are more coming from the west side and the east side who want park views but can't afford Central Park West and can't afford 5th Avenue. That's now 80% sold. It's not even completed yet. Prices have risen probably to $1,300, $1,400 a foot, starting at $1,100, $1,200, which has never been hit in Harlem. But I think, again, achieving those prices are because of the unusual premium nature of being right on the park. I'm not sure you could achieve the same thing, you know, 10 or 15 blocks north, but you don't have to in order to make money. On the rental side, a lot of this large portfolio we bought, again, of rentals, again, are well located. The properties are 25 and 30 years old, but if you can deliver rental product, $30, renovated product for $35 a foot, people will move to an area that might have been considered a changing area, but is changing for the better, and will, in order to get more space or an improved unit. So again, as long as you have economic growth and, you know, people with the willingness and good transportation to get to it, I think you'll see continued improvements in Harlem across the board. It's just all be relative. When you're talking about the office sector, we also own 2 office buildings up there in partnership with Cogswell Realty, and we haven't had much turnover. But I was just taking the train in from Connecticut this morning and seeing the site where Vornado's going to build, and they're talking rents $55, $60 on a gross basis, I guess.
Right, but you have to remember over there they get the incentives, the tax incentives, the REIT benefits. So for a tenant, you're going to be in there effectively at $43 a foot for Class A brand new building, and it's going to cost you anything in Midtown for $85, $100
It'll be very interesting to see how it goes. If they can get, you know, commercially viable companies, you know, big name companies to move there locationally, I think it'll spur additional growth. We look at our office buildings, the rents are in the high 20s, maybe low 30s. You know, we're not going to get $42, but certainly if we got to $35 or $36, we'd be very, very happy overall. So again, it doesn't happen overnight, but 1 or 2 successful projects, I think, can change the image of a neighborhood and spur additional demand.
4 million visitors are going to come to New York this year. 4 million visitors. New York is under-hoteled. You guys, you own a couple of hotels, or you've sold a couple of hotels. You are building, you're going to be buying some hotels, right?
That's correct.
You're building hotels or buying hotels. What's this? What do you love hotels in Manhattan? What do you think about hotels in the other boroughs? You don't even know about the other boroughs. You're allowed to stay in Manhattan, okay? we'll talk about Muttontown in a little while.
Well, the answer is we made a forward commitment to buy, a couple of limited sector hotels, one down the Wall Street area, one in the Flatiron District. And again, we committed a year ago. They're just maybe going to be completed in about 3 to 6 months. And we thought they were at price points of under $200 a night that could service that part of the market. And last November, we bought the Crown Plaza Hotel, full service hotel, right at 48th and Broadway, right next to Morgan Stanley's headquarters, Lehman's, and all that. We're going to put $50 million into to do a full renovation and make it a very nice hotel. Not going to be a 4-star, but we see the demand strong. And again, there's been quite a bit of hotel stock removed the last few years. But I would caution, and we didn't do a few deals recently, that there's a shortage of hotels, but there's also thousands of rooms being delivered. And I think,
and also at locations. I mean, we've been seeing deals at hotels. Oh, it's on 11th Avenue. It's pioneering. Those are pioneering sites. I mean, you just said prior to the show that you're building right across the street from my studio with a partner on 35th Street. So they probably will have a card to get if anyone checks in, they get a $10 gift certificate to go to Macy's.
But with the economic growth in the city, you have office product and business activity in a lot of different parts of the city that's growing. So it's not all just growing in one location. It's not all just the financial district, or it's not all the Plaza District. It's not all just one place. You have growth all over the city, so you have pockets of demand. That doesn't mean you can go and build 600 hotel rooms every single time, but in individual neighborhoods you can build boutique product, for example, and boutique product has become mainstream product. I mean, there's a whole category of people who stay basically exclusively at boutique hotels. That's what they like. They feel like it's a home away from home. So I think Manhattan and the boroughs, quite frankly, as well, are underserved today in terms of the total capacity of hotel rooms. When that reaches an equilibrium point, you got to check back in a couple of years.
I think we're concerned about it right now. There was a period of time where there was a lot of rooms at the high end that left and got converted to condo or what have you, and people literally doubled, tripled their rates, and you couldn't find a room in Manhattan for under $250 a night. And when we own the Quality Inn in Times Square, when you're averaging somewhere between $200 and $250 a night for a Quality Inn, that's crazy. And with that, I think there is opportunity, whether it's in the boroughs or in some of these fringe locations. I think we haven't done it, but somebody should really, do a crane exercise and really add up all the rooms under construction. And I bet you we're about at that point, if not, past it.
Well, there's a big component that has to do with what you're able to get the land for, what you're building, what quality you're building to. If you're assuming that you're going to open up like the Mandarin did at a $700 ADR, then you're fooling yourself if you're building it to those kind of projections.
I mean, Lower Manhattan today, right now, there are about 11 hotels in different planning stages. You're buying one of them. I mean, if you walk on Maiden Lane, you can see 4 of them or 5 of them being built. I mean, unfortunately, what we're losing in New York City is there's no more parking lots because they're being taken over to build hotels.
That's okay. We're getting congestion pricing coming soon, so
that's good.
It won't make economic sense to drive into the city.
I wouldn't say it. I would agree with Jeff. The answer is I would not consider that a long-term hold. This is a product coming on in Maiden Lane that's going to be a nice hotel, ADRs of $180. But I'd say again, it's something that we wouldn't look to hold for 5 years, because if you look at if there's 11 announced today, there'll be 22 announced next year, because again, if you have demand, builders are going to meet it, and you can't just shut off the construction cycle at a moment's notice. These deals take a year or 2 or 3 to develop. So, with
the exception of Mr. Kaplan over here, I know you like all the other boroughs. I know Jake likes the boroughs. He's allowed to be in Manhattan and the Bronx. What's your opinion of Brooklyn? I mean, Brooklyn today is the 3rd largest commercial district. I mean, residential housing is going great. Marty Markowitz is the cheerleader over there. Any thoughts about Brooklyn, Williamsburg, Greenpoint, downtown? I like
it long term. We're a major investor in Brooklyn. We're just starting a new condominium project in Sheepshead Bay. 110 units, pretty standard, smaller product, $650 a foot, but the nominal price point.
Are you gearing that to any specific group?
It's a very large Russian community there in Sheepshead Bay, and we're putting amenities that are not up to the Oceana standard, but probably above the average standard, and we feel very comfortable there. As you know, we have a major land investment in Coney Island, and the city is well on its way toward a major rezoning there. What product we will build there, what product we'll sell there, I think that's something, you know, for next year to talk about. But we are very optimistic that when you have probably a total of 30 acres of vacant oceanfront land in a growing community like Brooklyn overall in transportation, you will be able to create communities that will sell. The real question is pioneering. What's going to be the price point coming out of the box?
We don't have any problems or preconceived perceptions against Brooklyn or Queens.
I knew that,
for that matter.
Just was...
I think the issue is liquidity, you know, and I think what we're concerned about is that some of these crazy prices that we've gotten for any, or they're getting for any kind of product in Manhattan. You can support the rents that what rents need to grow to make that kind of deal work because of the growth in Manhattan. Will you see that kind of growth in the outer boroughs? And if you don't, in a downside, is there the liquidity? So, you know, I look at a city like London where we're a very active investor, and, you know, we are investing in the equivalent of a Brooklyn or Queens in London because I think the difference is the institutional mindset amongst the UK institutions is there's no discount. So, you know, there's an inside the M25 ring road, which would include really the 5 boroughs, and then there's other places in the UK. I think the American institution views Manhattan and then a step down to the outer boroughs.
I think just from our own experience, you look at the condo business, where we're selling condos in Brooklyn, and 2006 was a slow year for everybody. 2006 into 2007, our stuff in Manhattan has all picked up and it's all selling great. It's still been very slow in Brooklyn. So you do have that sort of effect of being in a secondary market where things are going to improve a little bit more slowly, and they're probably going to decline a little bit more quickly. So you just have to be a little bit slightly more careful, I think.
But there is a lot of, you know, the liquidity is not the fund liquidity, the institutional liquidity, but there's tremendous liquidity in a lot of these neighborhoods of Brooklyn, whether it be liquidity by a certain ethnic group or a certain overseas group. It is, you know, you go out to some of these neighborhoods and people you're bidding against, you don't recognize who you're bidding against in the name, but today they can garnish $10 to $20 million of equity capital and just as easily as a deal in Manhattan, and it's just from a different source of capital. So we haven't seen a lack of capital. Whether that capital will go away, if I think again, capital comes and goes.
You know, you bring up a very important point. Right now, you know, I wrote in my article, some of the real estate publications, it was in the Journal over the weekend, you know, that the capital markets, the lending markets have tightened up because maybe the underwriting has been refined. People don't want to lend on something that the Macklows could buy in 7 days and, you know, lend $7 million. Even the Macklows said this, and, you know, it happened in Stanford right now with RFR. We were talking part of the show. What do you think about this? I mean, will these inexperienced developers who were buying these properties because they were able to get 95% financing continue to buy, or is it going to be good for guys like you?
I think when underwriting standards are tightened, as they have been in recent weeks, I think that's ultimately good for well-established players because the lenders start looking more at sponsorship. And they won't take a flyer on a new bar, or they'll want to do a deal with someone with whom they have a relationship and who has a good reputation. On the other hand, I haven't seen, it hasn't been like there's been massive distress or the debt markets have shut down. We've seen that from time to time historically, but it hasn't been like that at all.
But what I'm saying is, and I think, Tom, you spoke to me when I was in Vegas, that you had done this large deal that you spoke about, this 4,000 units, and Deutsche Bank, who did the loan, wasn't able to sell off the paper. So this. Well,
they sold. They did not. Were not able to securitize the paper.
Securitize
they had to sell this, you know, a major piece of it on a fixed rate basis to Fannie Mae, and I'm sure if it was not at a profit, I'm not sure at a big loss. But liquidity in the short term, and they, again, remember, you got, it's estimated $48 billion worth of inventory in the investment banks from a lot of deals. So there's going to be a little dislocation in the short term, but I think it's a very healthy and a long overdue type of situation, because I think if the real estate community is going to be regarded as a premier investment class for the institutions that we go to for money, we can't, again, and we have done it twice in my career, destroyed the financial system. We're capable of that because we borrow a lot of money. The answer is it would be fantastic if we get small adjustments and prove that we can discipline ourselves, whether the rating agencies or the underwriters or the equity. I think it's a healthy type of thing and be something good before you had major deals created that could cause a confidence factor.
And I think that was the point of what the rating agencies were trying to do. They were trying to get out ahead of a potential problem rather than let the problem happen and then have to explain it like happened in the subprime market.
I hope it lasts, but I don't think so. I think it's a short, I think we've seen a short-term knee-jerk reaction where there was definitely pushback tightening, particularly for unproven sponsors, for cash-out refinancings, for
Jeff,
no coverage.
I think you're right. I mean, last week the office condominium component at 660 Madison sold for the highest price ever recorded for a space, $1,467 a foot. I mean, the Lipstick Building is still selling. I mean, all these properties. I think it's the question of what Jake says. Perhaps it's sponsorship. You're looking at it this way. You're not going to find someone who's coming in overnight and saying, "I want to buy."
There's one other thing. You talk about 660 Madison. It's foreign money. The dollar is cheap relative, particularly to the pound, but to the euro as well. That was an Italian buyer, I think.
And they're not relying upon the securitized market. Again, a lot of the competition we have as equity players, and I'm sure you guys see it, is really not other equity funds. It's the amount of debt that is being put on a particular transaction when you can borrow, if you call it borrowing, 95% of the deal. Every good developer doesn't need any real equity because the other 5% is illusory. I would like to see that not for our benefit, just for the health of projects, because it puts an awful lot of burden on when you have 95% debt.
I'd like to see it for our benefit too.
The British have a term called debt-driven buyers, and until that debt-driven buyer goes away, it's keeping the market, propping the market up.
Well, they regard it as just, I think, the inexperienced guys. It's an option on the real estate marketplace. So what you have is you do 10 deals rather than 5, and you get a downturn. You give back the 5, you keep the other 5. It's just a rolling option.
Well, we don't want to see the give back. You and I are older than the two of these guys.
I don't have time for another depression. Let's just say that. In either
recession, right?
Well, the answer is recession or depression. The answer is the give backs. But that's the way a lot of these new companies are doing it. They're able to take very minimal equity and do probably many more deals than the true underlying credit strength or management capability. Think about management capability of these guys.
So in essence, you guys who are they're the 800-pound gorilla, you're the 200-pound gorilla, are very bullish on New York. You continue to invest. You see the market continuing to do well. I think in essence you're saying let's be a little cautious on the hospitality market. Let's look at residential in the boroughs. But in all, we're saying that the market looks good. This little knee-jerk over here in financing, and things will continue to go well. I'd like to thank Jeff Kaplan, Managing Principal, Westbrook Partners, Tom Lydon, President of the City Investment, and last but not least, Jake Jacobson, Managing Partner at Apollo Real Estate Advisors, for being my guest. Thank you. See you next week.
Major funding for these programs is provided by HSH Nordbank and First American Title Insurance Company of New York, Perfect Building Maintenance, Allied Partners, Greenberg Traurig LP, the Moynihan Group. Additional funding is provided by Antares Real Estate, Arbor Realty Trust, C.B. Richard Ellis, City Habitats, City Investment Fund, Cushman & Wakefield, Eastern Consolidated, Essex Capital Partners, Fremont Investment and Loan, James D. Kuhn Real Estate Institute at Syracuse University, Massey Knackle Realty Services, Meridian Capital Group, McSam Hotel Group, MUSS Development LLC, Newmark Knight Frank, Palin Enterprises, Rosenthal & Rosenthal Inc., Swig Equities, the Engel Berman Group, Titan Capital, the WITKOFF Group, YL Real Estate Developers, Extreme Contracting and Deconstruction.